Yep, let's get back to the markets and your money after yesterday's 800-point sell-off for the Dow. Joining us now is Brian Levitt, global market strategist at Invesco for North America. We talked about that before. We got global perspective, but more about North America. David Bianco, DWS Americas CIO. Brian, I did not have a chance to talk to you earlier. I did spend a little time with David in makeup. Neither one of us were actually getting makeup. We were actually just talking.
We look this good.
Yeah, exactly. Anyway,
I was getting makeup.
Yeah, you were, and it's beautiful. It's
Thank
great. You. What we decided, David, and we go back a long way. You think that this is not quite finished yet as far as a correction, and that we may have a full-blown correction. We're down about 7%. You're saying that it could be as much as 10, 15, 20.
Well, the 20 is still unlikely, not that it's impossible.
From the highs.
I think what's likely is that a full-blown proper correction plays out, 10 to 12% decline from 3025, the S&P's high, to something about 2,700 on the S&P.
27.
We're already down 6.2%.
Yeah, and I think we'll go down about another 5.
Yeah.
So
and
12,
we might go down quickly now with a bit of a bounce, with a test in September, October. I think this is going to be a textbook correction. There's enough reasons for it. Valuations are not cheap. They are demanding. I know they're supported by these low interest rates.
Low interest rates.
But these low interest rates, particularly the possibility of something like a total of 100 basis points of Fed cutting rather than the 25-50 that we were thinking a month or so ago, this is a real threat to the profitability of the financial sector. So, you can trace this back to the trade war and the general deceleration of the global economy. In the past, you'd hear me talking about the threats to industrials and energy and materials and certain technology companies. But now this is becoming a threat even to something very domestic, the financial
Which is why
sector.
the financials were down 4%,
Exactly.
the biggest declining sector yesterday.
We talked about it, your worry that even though interest rates are low, that the multiple could contract to somewhere around 15. And it doesn't matter whether it's a multiple contracting or whether the slowdown that you're seeing causes earnings to go down. One way or another, you put 15 on a lower earnings, and can you get to 2,500 on the S&P?
Easily, a 15 multiple.
On the S&P, you get to 2,500.
I don't think earnings will. I think earnings will be $163 this year.
Yeah.
No growth this year now. And I think earnings will be $173 next year.
And what multiple do you give with rates where they are? You should get something for that.
Yes, with rates
there is no
where they
alternative.
are.
Yeah.
And if we were to be comfortable and confident that we were going to get mid-single-digit earnings growth, I'd be comfortable with an 18 trailing PE on the S&P 500. Until then, I think it's 17 and a half at the highest, with the possibility if people get more unnerved that the PE could fall lower than that.
Right. I didn't talk to you, but you heard all that.
Mm-hmm.
Were you nodding or were you rolling your eyes?
Well, I mean, I'm nodding when we're talking about this downturn in markets. I mean, downturns come with policy uncertainty, and we have a lot of policy uncertainty right now. So I think investors should get back to what the bigger picture is, which is it's a slowing growth environment, modest inflation, accommodative policy globally, low interest rate environment. All that should be good for equities, but we need to know the rules of the game. So until we get there, I think there's going to be a churn. I think the Fed steps in. I think at some point in an election year, we're going to have some agreement to, I don't think we're getting a framework trade agreement, but some agreement to push this off a bit into the future. And I think equities will respond to that.
How do you think you're going to know the rules of the road, though, when things seem to be changing so rapidly?
Well, that's part of the problem. That's the issue that we have right now, because we had a good economy, and then you start to see sentiment fall as we add additional tariffs. As sentiment falls, capital goods orders falls, the ISM indices fall.
Is this the Fed's fault, or is this the trade war?
No, I don't believe this is the Fed's fault. I mean, the Fed had an issue in 2018 in that they had tightened financial conditions amid pretty good economic growth, and they rightfully backed off, and they eased interest rates in June. So I don't think that this is a Fed problem.
There are people who think it is, and think that they're way behind. They think that there was 400 basis points of tightening when you take the balance sheet and everything else, and they're so far behind now where the yield curve is on the short end that almost a 50 basis point would make sense.
Well, it's funny because we had people for so long who thought that the Fed was too easy for too long. My concern was that anytime the Fed signaled additional interest rate hikes, the dollar would strengthen, the yield curve would flatten, we'd tighten financial conditions. So they needed to back down, and they're doing so.
But to Becky's question, do you think this is a trade story, or this is a trade war story, or do you think of this as a global economic story and trade is a piece of a larger puzzle, which is to say that really things started to turn the wrong way yesterday as a function of what was happening in Germany?
Right. I think this is a byproduct of what's going on with trade, the uncertainty around trade that is slowing U.S. growth, slowing Chinese growth.
You think if you took that off the table, everything else is...
Well, not everything else is great, but in the United States, 2% growth, 2% inflation, an easy Fed was a fine backdrop. As soon as we started to muck around with policy, whether it was stimulus, then it was rate increases, then it was trade, we disrupted.
Do you agree with this?
Yeah, I'm listening to Brian, and I agree with a lot of what he said. I mean, I would say a couple of things, and I've always tried to point out there's always a difference between GDP, the U.S. economy, and the S&P, and the profit situation at the S&P, even before we get to the valuations. And this is a healthy economy. However, even before the trade war, people had to realize that we had a deceleration in investment spending, excess capacity in the commodity complex, things that are important drivers of profits were already slowing down.
That's what I'm suggesting.
Then the trade war exacerbated it.
The jobs numbers always looked good on top, so we all thought... Right, and then the question is now people are looking at capex spending, saying that's not where it is.
It's a good economy. It's just a tougher environment for profits.
As fast as it should be.
Right.
Hopefully, it's not the 10 years of central bank easing. You know, when we talk about the 30, we talked about this yesterday, 30-year at an all-time low yield, that means 30-year bonds have never been more valuable. It was weird to think of it that way yesterday.
Right.
Was it? 30-year bonds have never been more valuable than they are right now, which gives us leeway with our deficit issues because everything
to issue
that we
more 30-year, even go to 100-year.
That's the thing. I think
issue the 100-year.
I mean, the deficit at least is, but what threw a wild card for me into this whole China thing. I mean, suddenly we're talking Hong Kong, and they're mad at the way they're actually pointing fingers at us for how we're responding to what's happening in Hong Kong. That 6 months ago, that had nothing to do with what we were talking about. We were talking about soybeans. We were talking about electronics.
For a long time, this trade war has wrapped a lot more into it, including North Korea. That's been part of the talks the whole way through.
And there'll be more talk of human rights and even environmental concerns, which there are a lot of Democratic nominees who believe that there are even more issues that should be brought into the trade debate.
I was actually surprised that President Trump even raised the issue of Hong Kong yesterday. I mean, I appreciate why he was doing that. But given where we are and actually how fragile it is, to connect those two actually makes his job that much more complicated.
It's hard not to, though.
I appreciate that, but by the way, there have been lots of times
leadership,
where
and do we pull back?
Do
we, and what can we actually do? Wilbur Russell was yesterday. What are we supposed to do? Invade Hong Kong? But Cisco out last night. It was bad forecast, and they had some problems with dropping revenues in some of the units. But when they actually drilled down on China, and they did mention China, but when they drilled down on it, it's 2% of their revenue, and it was 25% weaker. So that still is not. Maybe you're talking about this overall feeling about the trade war and uncertainty causing it, but you're still not seeing it. If you drill down in the numbers,
it's hard to separate. Like our business is pulling back because
there's a lot of things. And look, I look back, and there for a decade or more, I used to think take every good business model in the S&P 500 and just replicate it all around the world. Now I spin the globe, and I'm like, I've got just concerns all around the world. So it's a tougher environment to grow.
Yesterday, Wilbur tweeted. Did you see Wilbur, Secretary of Commerce? Wilbur tweeted after the show and said, "I wish I could have made the point that tariffs have not affected import prices or companies in this country yet," but I mean, he implied he was cut off. I don't know who would have done that, but he implied that he was not able to. But you know, there's a
But I did see a lot of people saying the point being, look, you're doing this to save U.S. consumers.
Right.
Then there must be an impact from the tariffs down the road.
It looks to me
right. If China's paying for the tariffs, then why?
These tariffs are going to be eased in and left in for a long time. That's what it looks like to me.
Wilbur Ross is right about import prices, but when you start to see flight to quality, some strength in the dollar, the yield curve flattening, David's points about what that means for the banks, we know what credit means for the lifeblood of an economy, you start to see where the problems start to surface. The good news is that these are self-inflicted, right? So we can ease. We don't have to sit here with a flat yield curve. We can ease policy conditions. Central bank doesn't run out of ammunition, and the administration could take some steps to try and ease some of this pain around trade.
So is the inverted yield curve a signal of a coming recession?
Well, we're not inverted. We were inverted for a brief moment. We're a basis point wide right now. No, I mean, just because you invert briefly in a low inflation environment,
in a low interest rate,
and a low interest rate, the Fed can ease conditions.
I think I could make that point. Like if it's 7% on the short term and 6% on the third, I can see how that's nuts. But then I saw Kramer tweeting this morning. Someone said, Jim, we went from 2 basis points not inverted to 2 basis points inverted, and the world ends. Where were we for the last 3 months? And Jim goes, do you have any idea what these in this $1 trillion bond market, what these moves we've seen in the past couple of days have been really significant? And he said it's like a small cap stock trading on steroids. So these are big moves, even though it's de minimis in terms of the basis points,
massively.
there's something really happening here, or could be.
There is.
Anyway.